Welcome to Where the Ledger Ends, the podcast that explores the intricacies and challenges of technical accounting through the lens of SEC investigations. I'm your host, Casey, and I'm joined as always by my co-host, Emily.
In today's episode, we're tackling one of the most egregious accounting fraud cases in recent years, the scheme that wreaked havoc at Roadrunner Transportation Systems, a leading transportation and logistics provider in the United States. With a business model focused on offering customized and expedited transportation services across a wide range of industries, Roadrunner faced intense pressure to grow rapidly in a highly competitive market.
That's right, Emily. And as we'll see, this pressure led the company to embark on an aggressive acquisition spree that ultimately set the stage for a massive accounting fraud. This case has it all: earnout manipulation, internal control failures, and a web of deceit that unraveled spectacularly.
For those not familiar with earnouts, they're essentially contingent payments that an acquiring company promises to the sellers of a business if certain financial targets are hit post-acquisition. But as we'll see with Roadrunner, these earnouts can become a dangerous tool for accounting manipulation if left unchecked.
So let's dive in. Our story begins in the early 2010s, when Roadrunner, a shipping and logistics firm, embarked on a massive acquisition binge.
From 2010 to 2017, Roadrunner was on a buying frenzy, scooping up over 20 smaller shipping and logistics companies in just a few years. The goal was to rapidly expand Roadrunner's scale and market share in the highly competitive transportation industry.
And a key feature of many of these deals were earnout provisions. Essentially, Roadrunner would agree to pay the sellers additional consideration if the acquired companies hit certain EBITDA targets in the years following the acquisition.
Exactly. And under GAAP accounting rules, specifically ASC 805, Roadrunner was required to record a liability on its balance sheet for the fair value of these potential earnout payments at the time of acquisition.
Then, in each subsequent reporting period, Roadrunner had to reassess these earnout liabilities based on the actual and forecasted performance of the acquired businesses. If an acquired company was underperforming and unlikely to hit its earnout targets, Roadrunner would need to write down the liability with a corresponding benefit to earnings in that period.
On the flip side, if an acquired company was overperforming, the earnout liability would need to be increased, reducing Roadrunner's earnings.
So these earnout liabilities could swing Roadrunner's reported profits in either direction based on the performance of the acquired companies, and this is where the accounting gets complex and subject to manipulation.
You said it. And to give listeners a sense of the scope of these earnouts, let's look at some of Roadrunner's major acquisitions. In 2012, they acquired R&M Transportation for $24 million, with a $5 million earnout tied to future EBITDA targets. That same year, Roadrunner bought Expedited Freight Systems for $10 million, with another $4 million in potential earnouts. In 2013, they purchased Adrian Carriers for $14 million, with earnouts up to $6.5 million.
So we're talking about tens of millions of dollars of contingent consideration riding on whether these acquired companies could meet Roadrunner's lofty performance goals. And, as we'll see, many of them will fall far short.
By mid-2013, it was becoming clear that several of Roadrunner's acquisitions were not living up to expectations. For instance, R&M Transportation and Expedited Freight Systems, two of the biggest deals, were missing their earnout EBITDA targets by wide margins.
Under accounting rules, this should have triggered significant write-downs of the earnout liabilities Roadrunner was carrying on its books for these deals. But instead, then CFO Peter Armbruster and controllers Mark Wogsland and Brett Nags used a variety of tactics to delay and manipulate the liability figures.
One of the deceptive methods employed by the company was to create unrealistic financial forecasts to justify maintaining inflated earnout liabilities, despite the company's poor performance. According to GAAP, the company's underperformance should have triggered significant reductions in the earnout liabilities, which would have had a positive impact on Roadrunner's earnings. However, with Armbruster's knowledge and approval, the company used baseless and overly optimistic hockey stick projections, which predicted a sudden and dramatic turnaround in financial performance. These projections were used to avoid and postpone the necessary write-downs of the earnout liabilities, effectively creating an earnings reserve.
Armbruster and his team used unrealistic projections to avoid writing down EFS's $3.2 million earnout liability, even after it became clear that EFS was not meeting its targets. Less than a year after acquiring EFS in August 2012, the company's earnings in Q1 and Q2 2013 fell far short of the levels needed to trigger the full earnout payment.
That's right. The EFS earnout was based on the projection that EFS's earnings would steadily grow 10 to 11% annually, from $2.5 million in 2012 to over $5 million in 2016. Instead of reducing the EFS earnout liability to zero in Q2 2013 as required by GAAP, which would have resulted in an additional $2.7 million in operating income, Armbruster worked to create artificially inflated earnings projections. These baseless forecasts projected EFS revenue growing by over 67% in 2014 and another 40% in both 2015 and 2016, despite no justification for such a huge increase compared to the original 10 to 11% annual growth projection.
Based on those fraudulent projections, Armbruster only reduced the EFS earnout liability by $495,000, preserving $2.7 million on Roadrunner's balance sheet. This manipulation allowed Roadrunner to meet its consensus EPS target in Q2 2013, create a financial cushion to inflate future earnings, and give the false appearance that EFS was still on track to meet its performance goals.
Armbruster and his team used similar tactics for the struggling R&M Transportation acquisition in 2013 and 2014, propping up the earnout liabilities with unsupported pie-in-the-sky sales projections.
Armbruster's scheme involved keeping the earnout liabilities artificially high, essentially building a slush fund of excess accruals. This allowed him to create what the SEC called cushions, or cookie jar reserves, that could boost earnings whenever needed. In periods where Roadrunner's actual financial performance was lagging and the company was at risk of missing earnings targets, Armbruster would dip into this cushion by suddenly writing down the previously overstated earnouts. This tactic provided an artificial boost to Roadrunner's earnings per share, as the company could recognize significant gains from reducing the inflated earnout obligations.
A prime example of this exploitative tactic can be seen in Roadrunner's acquisitions of R&M Transportation and Central Cal Freight in late 2012. By inflating the earnouts associated with these acquisitions, Armbruster created a reservoir of excess accruals that he could later tap into to manipulate Roadrunner's reported earnings. This scheme went beyond just concealing underperformance. It actively distorted the company's financial picture, misleading investors and regulators alike.
Exactly. In late 2012, Roadrunner acquired R&M Transportation and Central Cal Freight with earnout agreements of $5 million and $4 million, respectively. By the end of 2013, it was clear that both companies were falling far short of the aggressive earnings targets tied to those earnouts. Armbruster knew that the total earnout for R&M was likely to be no more than $500,000, and Central Cal was on pace to miss its 2013 threshold by 43%.
Under GAAP, Armbruster should have written down the combined R&M and Central Cal earnout liabilities by nearly $4 million in Q4 2013, providing a one-time earnings boost. But instead, he delayed those adjustments and approved inflated projections to keep the liabilities on the books. In R&M's case, he signed off on an earnout liability of $1.8 million, over 300% higher than the true maximum payout.
Right. It was like having a piggy bank he could smash open anytime he needed to juice the numbers. But those earnout write-downs alone often weren't enough to bridge the entire gap between Roadrunner's actual results and its earnings goals. So at the same time, Armbruster would improperly defer known current expenses into future quarters, thereby reducing costs in the current period and inflating earnings.
The net effect was that the earnout manipulation and expense deferrals worked hand in hand to mask Roadrunner's true financial condition. The artificially inflated earnouts gave Armbruster a reservoir of imaginary gains to tap into when needed, while the deferred expenses reduced current period costs. Together, these schemes allowed Roadrunner to consistently report financial results that met or exceeded analyst expectations, when in reality the company was facing significant challenges and underperformance.
This two-pronged manipulation was a key reason the fraud was able to persist for so long. The earnout write-downs and expense deferrals often offset each other and made Roadrunner's reported numbers seem credible, when in fact they were the result of pervasive accounting gimmickry. It was only when the company was forced to restate its financials and disclose the full extent of these improper practices that the house of cards collapsed and the true impact of the fraud came to light. It's important to note that the fraud extended well beyond just earnouts. Roadrunner also improperly delayed recognition of customer cargo claims, failed to write off worthless assets and uncollectible receivables, and managed its accrual recognition to hit debt covenant ratios. But the earnout manipulation was arguably the most brazen and impactful aspect of the scheme.
As Armbruster, Nags, and Wogsland continued their multi-pronged scheme of earnout manipulation, expense deferral, and other deceptive accounting practices, they knew they had to keep the scheme hidden from the eyes of Roadrunner's auditors. To do that, they resorted to outright deception. In 2013, Armbruster sent the audit firm falsified financial reconciliations that concealed the true underperformance of the acquired companies. When the auditors began asking tough questions, Armbruster's team sent them fraudulent reconciliations to justify the numbers. They also directed lower-level accounting staff to conceal information that could draw attention to the misstated accounts or other accounting problems.
But the auditors were catching on to the troubling pattern of inflated earnouts and unexplained expense deferrals. In 2014, they started raising serious concerns about Roadrunner's accounting and internal controls.
Armbruster's response was to falsely assure the auditors that the issues were being addressed. But behind the scenes, he was still directing his team to find ways to avoid earnout write-downs and boost earnings through manipulative tactics.
The scheme finally started to unravel in early 2017, when Roadrunner's audit committee launched an independent investigation into the company's accounting practices.
The investigation uncovered the full extent of the earnout manipulation and expense deferral scheme. In January 2017, Roadrunner announced it would need to restate 3 years of financial statements due to accounting errors and irregularities.
The fallout was swift and severe. Roadrunner's stock price plummeted over 30% on the news. CFO Peter Armbruster was promptly fired, and the company had to take a staggering $66 million charge to correct its inflated earnout liabilities and other accounting improprieties.
In the following months, Roadrunner was hit with shareholder lawsuits, delisting warnings from the NYSE, and a formal SEC investigation. The company had to scramble to renegotiate its credit agreements and convince lenders not to force it into bankruptcy.
Ultimately, in April 2019, the SEC charged Armbruster and controllers Wogsland and Nags with accounting fraud and misleading auditors. The DOJ also criminally charged Armbruster in the same month. In July 2021, following an 11-day trial, a jury convicted Armbruster of 4 counts of violating federal securities laws, including misleading a public company's auditors, securities fraud, and keeping false books and records. He was sentenced to 24 months in prison and fined $1.1 million.
Beyond the impact on Roadrunner and its executives, this case is a stark reminder of the risks posed by earnouts and the importance of strong internal controls around M&A accounting.
Absolutely. While earnouts can be a useful tool in deal-making, they create complex accounting challenges and opportunities for abuse if not properly monitored. Acquiring companies need to have robust processes in place to regularly reassess earnout liabilities based on actual performance, not just rosy projections.
And as we saw with Roadrunner, auditors need to be extra vigilant in scrutinizing earnout accounting, especially when companies are doing a high volume of acquisitions with contingent consideration.
The Roadrunner scandal also highlights the dangers of using accounting manipulations to chase short-term earnings targets. What started as a misguided effort to conceal underperformance quickly snowballed into a massive fraud that destroyed immense shareholder value.
It's a cautionary tale for executives, auditors, and investors alike. When companies start playing games with their earnouts and expenses just to beat quarterly expectations by a few pennies, it's often a sign that something is rotten under the hood.
As we wrap up this deep dive into the Roadrunner accounting scandal, it's worth reflecting on the broader implications for financial reporting and corporate governance. The pressures and incentives that drove this fraud, the relentless focus on short-term earnings growth, the aggressive M&A strategy, the weak internal controls, are by no means unique to Roadrunner.
In today's business environment, where companies face intense scrutiny from investors and analysts, the temptation to cut corners or manipulate numbers can be strong. But as the Roadrunner case so vividly illustrates, the consequences of crossing ethical lines can be devastating, not just for the individuals involved, but for entire organizations and their stakeholders.
So what can we learn from this cautionary tale? For finance professionals, auditors, and corporate leaders, it underscores the critical importance of robust internal controls, rigorous compliance, and a steadfast commitment to integrity and transparency in financial reporting.
It also highlights the need for vigilance and professional skepticism when dealing with complex accounting issues like earnouts. As we've seen, these contingent liabilities can create opportunities for manipulation and abuse if not properly monitored and controlled.
Ultimately, the Roadrunner scandal serves as a stark reminder of the high stakes involved in financial reporting and the vital role that each of us, at every level, plays in upholding the integrity of our reporting functions.
Management also should have fostered a culture of transparency and integrity, not one where deception of auditors and manipulation of numbers was tolerated or encouraged. Yes, hitting short-term targets is important, but never at the expense of long-term credibility.
And when legitimate challenges arose with underperforming acquisitions, Roadrunner's leaders should have been forthright with investors and worked to address operational issues rather than obscuring problems with accounting manipulation. Deferred expenses and inflated earnout liabilities can only kick the can down the road for so long.
Ultimately, while stronger controls may have helped, the issues at Roadrunner started at the top, with executives who were willing to compromise standards for the sake of meeting unrealistic expectations. As business professionals, we must always remain vigilant and steadfast in the face of such pressures. The integrity of the ledger is paramount. We hope this deep dive into the Roadrunner case has provided you with a deeper understanding of the complexities and pitfalls associated with earnout accounting, as well as the critical importance of robust compliance and controls in the world of financial reporting. If you found this discussion engaging, we encourage you to explore our other episodes of Where the Ledger Ends for more insights into the fascinating realm of high-stakes financial reporting.
This is your host, Casey and Emily, signing off. See you next time.